Biden's stock market is up 8 days in a row.
Oh, that was so good.
Not bad.
I mean, honestly, he's there. I don't even think it's not even debatable, right? He's genuinely the funniest president we've ever had.
Oh, definitely.
James Polk had like a good sense of humor, but
George W. Bush was funny.
He was funny. Yeah, no, he's hilarious.
Did you see him? He was. They had the cabinet meeting, and he goes, they're the chief ripper offer. He's calling China the chief.
They asked him at the 100 Days event, they asked him what's the biggest mistake he's made so far. He said, that's really the toughest question because I don't think I've made any. It's so yeah, 100%. That's what he said. To me, it's incredible.
I mean, he's been on. Remember when he rang the bell at the stock exchange, and he's interviewing Kramer, and Kramer's asking him about But he's like, well, I don't want to be in your position. Basically, like if people will hold it against me if I give them some bad advice. You know all about that, don't you?
No, dude.
It's just
savage. Credit to
Savage.
Jared Dillon. He said something like, he's literally ringing a bell at the top. It was pretty good.
Yeah. I mean, he also called the bottom when he did this whole Biden stock market thing.
I would basically say that when any president, when you get into like Q2 after the inauguration, it's kind of yours. I do agree with Trump. You can't necessarily hold him responsible for like what goes on in February, March. But then if you make this huge tariff announcement, then it's kind of yours. Because that's what the market
yours.
Well, because that's what the market's reacting to now. The market's not reacting to GDP from nobody cares about that.
I mean, I thought the market was, I didn't think it was a good GDP number.
The problem is whose stock market was it from November 2nd until now?
Well, he took credit for the gains after the election.
Right. Nobody everyone gave him credit.
As he should have.
It was
nobody said in November this rally is because everyone's so excited about Biden.
He's the only one that can get away with it's my stock market when it goes up and it's his when it goes down. I mean, he might be doing that until through the end of the year.
Yeah, no, dude, the last 30 days of Biden's administration were super good for the stock market. Like Biden was destroying it. Thank you, John.
I think the stock market was insanely excited that Biden was leaving and that it wasn't Kamala and that it was Trump. So I think he does get that rally, even though it's during Biden's time.
I mean, people bet on tax cuts, deregulation, and tariffs, but they bet on it in that order. Yeah. So
you are looking very fly. Where were you before this? Were you on TV?
Fox Business with Charles Payne.
Okay.
Is that over at Avenue of the Americas?
Yeah, it's just up this street. Yeah.
Yeah.
6th Avenue.
Callie does that show.
I was supposed to have.
I've only met him once. He seems like a nice guy. Charles Payne.
Yeah, he's a really nice guy. I like. I don't get on CNBC. That's my.
What the is that about?
I have no idea. I mean, Sarah Eisen did. I mean, I knew her from her Bloomberg days, so she finally got me on like a week or two ago.
Wait, you don't know why they won't have you on? Because we do. I'm just kidding.
We don't do Economists on halftime.
Well, I know I did meet Scott when I was going on with Sarah and Carl that day. So
I'm trying to say, like, it's not like we have 5 people that are in your lane and not you. We don't. Yeah, we're like hardcore stocks.
Scott's more of a, I think, Jeff DeGraff fanboy.
You know what else we don't do? We don't do CEO interviews
on halftime.
No, almost never. We used to. But
you do more than just halftime, don't you?
No.
Oh, really?
No.
It's just halftime.
People think it's more than it is. I do 2 episodes of Halftime Report a week. That's it.
Oh, it's you and Stephanie that have like the.
Yeah. Well, Stephanie will pop up on Squawk Box a lot. I've never been on Squawk.
She doesn't like me much these days because I'm more bearish.
Oh, stop.
Wait, what was your final trade?
I'll tell you right now about Stephanie. She doesn't listen to anyone. She doesn't give a shit. She works her ass off. She has her opinions, and she's not worried about other people. We don't do CEO interviews. I think it's not because they're not informative. It's that they basically read from a press release. Most CEOs, they're very careful. They're rarely going to break news. Like anything that they say, you kind of already know, and there's a really great perch for that on Squawk Box. That's the show where they do the best.
Where they do that. Yeah.
Yeah, like during earnings season, they always have like the top CEOs. So it's like, why repeat that again at 12 o'clock?
Right.
You know what I mean? So we stay in our lane, but people think that I'm on a lot more than I am. I'm just doing.
Did Barry give him that Rolex?
No.
Not a Rolex.
No, that's not Breitling.
This is a Breitling Super Ocean Heritage. Not a Rolex. It's nice, right?
Yes.
I've always liked Breitlings because they're
It's
big.
like the Hulk.
Because they're big, and I need like a substantial thing.
Neil, I have to say, your Instagram account, very wholesome. I love it. It's you and your family. I love it.
That's it. Yep.
It's the kids. It's videos with the wife. You guys are hilarious.
Yeah.
There's no macroeconomic commentary.
No, none at all. No, it's just a repository for the kids and memories, basically.
How old are your kids?
My oldest is going to be 9 this month, and I have twins that'll be 7 in October.
Okay, what sports do they play?
My oldest plays soccer.
Okay.
My younger boy, so we have boy-girl twins. He is not involved in any sports right now, but he does taekwondo, and he does.
Oh wow!
And he's so in summer camp we got him in wrestling. I mean, he's a firecracker.
He's got some aggression.
Yeah, and
Okay.
and I think it's good for him. And my daughter is a girly girl. I mean,
Okay.
she's ballet, and if
Okay.
there was a summer camp class for like painting your nails, I mean, she would do that too.
You'll appreciate
that
this.
sounds like my kid.
As parents of young children, I had to reset. I think Kobe got like a Minecraft something or whatever he wanted. It had to go to his email account. I opened up an email account from when he was born, and I hadn't been in there since I opened it up.
Okay.
And I saw all of the things that I used to send him. And for whatever reason, I stopped emailing him in like 2019. So I would email him like videos, like this happened on this day.
Yes.
And it was like, holy shit.
My wife does that.
But I haven't
Yeah.
done it in like 4 or 5 years. So I'm going to start
Wait,
doing
what
it
were
again.
you? What was he? 2 years old in 2019?
Yeah. So just
what were you emailing him?
so that in 15 years he can.
Oh, I see.
Yeah.
Did he ever look back at it?
He's 8.
Right, but did he ever? Has he opened the email?
He
other
doesn't
than
know what email is.
Okay.
Yeah. No, he
Got
will
it.
one day.
I got it.
Didn't you go somewhere recently for spring break?
No, we stayed home. I have a puppy.
Oh,
So we're grounded.
yeah. I'm very much anti pet.
It's a lot. I forgot
I
how much
mean,
work
it's
a puppy
like-
was.
yeah.
But we
Yeah.
love dogs.
There will never be a pet in my house.
No.
Never.
I mean, if it's holding you down, I mean,
It's never gonna happen.
so you have to find someone.
Josh's not a dog guy.
No, I like dogs.
No, you
My-
don't like dogs.
I do.
You don't
I grew
like
up with a
dogs.
dog.
You don't like dogs.
Don't put that
I've
out
seen
there.
you around dogs.
Don't fucking put that out there.
Sorry.
I love dogs, but
You
my
hate
wife
dogs.
doesn't want another thing to clean up after.
Right.
So-
This is Josh. No, I love dogs. Don't
Stop. I stop. I think I like the idea
Well,
of dogs.
I mean, I'm more of a cat person myself.
That explains a lot.
Yeah. Yeah. My wife and I, years ago when we were first dating, married, we had a Sphinx cat.
Oh,
Mm.
wow. Very sophisticated.
Do those even like you though?
They love you.
They do?
Yeah.
Really?
They're like very dog-like in
Okay.
that sense, but less maintenance, obviously.
Gotcha.
All right, let's get this shit started. In the words of the great Roddy Mund. Let's go.
Good with the headphones.
All right.
3 claps. Compound and Friends, episode 190.
Today's show is brought to you by X-Trackers by DWS. Imagine harnessing the power of global transformation, investing in artificial intelligence, critical technologies, semiconductors, and green energy. With X-Trackers' innovative thematic lineup, you gain access to the ETFs that target these transformative sectors. It's more than investing, it's aligning with the innovations that are shaping tomorrow. Whether you're a seasoned investor or just starting out, X-Trackers makes exploring new opportunities seamless. Find out how at xtrackers.com. Together we grow. All investments involve risk, including loss of principal. Information on the fund's investment objectives, risk factors, charges, and expenses can be found in the fund's prospectus at xtrackers.com. Read it carefully before investing. Distributed by Alps Distributors, Inc.
Episode 190. Believe it or not. Ladies and gentlemen, welcome to America's favorite investing podcast. My name is Downtown Josh Brown. For first-time listeners, this is the show where we talk about what happened this week, what should happen next week. We look at markets, we look at the economy, stocks, bonds, interest rates, the Federal Reserve, and all sorts of other stuff. I'm so excited to let you know that Michael Batnick and I are joined by friend of the show, been on the show a couple times. I think one of the most popular guests Neil Dutta is the partner and head economist at Renaissance Macro Research with an emphasis on analyzing the U.S. economy, the Federal Reserve, global trends, and cross-market investment themes. Prior to RenMac, Neil spent 7 years at Bank of America Merrill Lynch. There, he was a senior economist covering both the United States and Canada. Neil Dutta, welcome back to the show.
Thank you, guys. Always a pleasure.
All right, we're so excited to have you back. This is a perfect time. Not that every time isn't a perfect time, but this is truly a perfect time to have you here. I heard you tell Paul Krugman. I heard you tell Paul Krugman that you are a business economist.
Yes.
And it was really important to you, the way I remember it, it was really important to you to make that distinction. I think Paul Krugman would not call himself a business economist. So what do you mean by that?
Well, I'm not a formally trained economist. I got a bachelor's degree in economics. I did master's coursework in economics, but I don't consider myself an academic economist. These guys.
That's the distinction, academic versus business?
Well, yeah. Well, I think that, they spend years in school, focusing on one area of the subject, right? Financial economics, in Paul Krugman's case, trade economics, right? As a business economist, you very much lean on a lot of the work they've done. But I almost think of it like these guys spend their entire lives PhDs to basically take the football to the 10-yard line, and then as a business economist, you sort of take their work, tell investors why you think it may or may not be relevant for what's going on right now, and then you are the one that gets to run it in for a touchdown. So for me, that's sort of how I view it. But yeah, a business economist in my mind is someone that tries to use the economic data that's released. And as everyone knows, there's a bevy of economic information that comes out every day. And then try to formulate some kind of economic call that is useful for a market participant.
Yeah, I took it that way. I think he did too. I thought that was interesting though, because it's one thing to publish papers, and that's important because you have a theory, you test the theory. Why does this do this? Why does this do that? But then you need somebody that comes along and says, okay, given A, B, and C, here's what we do with that information. And so I think that's how you see yourself.
Yeah, and it's also like a respect. To me, it's like an academic economist, they are probably much better at math than I am, right? They're probably much better at MATLAB and eViews than I am. They're doing, very hardcore work, and they're spending their entire time doing that. Frankly, like a lot of people on the street, business economists like me, we are doing a lot of other things. And so I think to me, it's like a respect level. They're breaking ground, and and coming up with totally new applications for the science, right? So I think to me, that's why I try to make the distinction that it's not, we say head of economics at RenMac, chief economist. Those are titles that people throw around.
Right.
That's really a legacy issue.
A lot of the academic economists don't necessarily care, at least day to day, about the stock market, how it impacts the economy, the circular reference and nature of those two interchanging. So let's talk about the stock market.
I wanted to ask you, how did it feel being interviewed by a Nobel laureate? That's kind of what I wanted to get from that. That's pretty cool.
It was very, I was very nervous. But it was, look, when someone like that he said he read some things I've written. That is huge for someone like me. Yeah, it's really cool.
Okay, I also am a Nobel laureate. So
in what?
Not in economics.
I live on the block that Paul Krugman grew up on. Did you know that?
Yeah, that's actually a true story.
That's a true story. I told him that.
We met Paul at Barry's birthday party, and he grew up in our town.
Oh wow!
And the house that
he was the
in,
nicest guy it's
super nice guy.
It's sort of interesting because his I've read his columns for years when he was at the Times, and it's so cutting the way he writes. It's visceral.
He's a firebrand
100%
as a columnist, but not in real life.
No, he's the nicest guy in real life.
So
sorry, I stepped on your segue. So sorry. So sorry.
So it's a bull market.
Okay.
Listen, the stock market is. I'm not. This is not a forecast. The stock market is behaving like we're in a bull market. We're up for 8 consecutive days. Pretty rare. Luke Kawa tweeted yesterday, in the midst of this, on the 6th up day in a row, we had the biggest intraday loss that was erased for the S&P 500 since the bottom in October 2022.
I spoke to Luke about that, actually.
So the stock market is looking past a lot of negative news that is surely to come. So please, Neil, explain to us what the F is going on in the stock market.
Well, I don't trust little tidbits from Canadians, and so
shout out to Luke Cower. We're not gonna bury anybody today. Go on.
No. Yeah, look, I mean, I mean, it's, Wiesenthal makes this point about how, well, I guess it was all priced in, right? And we're basically back to the obliteration day.
We took it all back.
Equity market. I mean, look, to me, as I said before, I mean, it's about using an economic call and trying to tie that into some kind of a market call.
So is the economy better today than it was a month ago? Are the prospects for the forward economy better today than they were a month ago?
No, because I don't believe so, because I think fundamentally this is an economy that's slowing. And remember, the stock market's been doing great for a long time. That hasn't stopped the economy from still slowing down. And so I think there's a distinction here between financial market conditions and real economy sort of financial conditions, right? Like, so when you see things like, lower tier credits, delinquency is going up, car repossessions going up, things of that nature. And obviously, even in the GDP data that was released earlier this week, there was a massive boom in information processing equipment and software. Now, that could be AI related, that could be companies pulling forward some activity because of tariffs, but it's undeniable that technology is a huge driver for growth right now. And not surprisingly, also a big driver for what's going on the equity markets.
You floated 3 possible explanations for the rally in the stock market over the last week this morning. I'll read them to you, and then I want to hear which of these you believe in the most if you had to pick. 1, perhaps the bond market understands that the real economy is not in the same place as the technology sector. Financial market conditions being loose hasn't helped keep the economy from slowing over the last year to begin with. 2, perhaps the equity market sees President Trump caving on the trade war, this is mine, or backing off to some degree, but it seems harder for him to capitulate if stocks are up at these levels in the first place. Meaning, markets rallying for 8 days, they must love my trade policies. Okay, got it. 3, credit spreads have not really moved on the run-up in stocks over the last week. Finally, I feel like the economy is, this is the 4th. Finally, I feel like the economy is innocent until proven guilty. There was a big clearing event earlier this month, and bets on recession in years prior have never materialized. So I think it's a little bit of that. Like, I'm not going to get fooled again by the new recession because none of the other ones ever happened. But then I also think, and Michael and I argued a little bit about this on Tuesday, stock market thinks the trade war is basically over. That's what I'm getting. What do you think?
I think it's some combination of the first thing.
Look at this trade policy uncertainty.
So this is Josh's point, and I think there's a lot of truth in
crashing.
that.
The trade policy uncertainty is crashing.
Peak uncertainty is obviously behind us. There's obviously still uncertainty, but we're not peak uncertainty.
Well, I think it's about what he's actually doing, right? I mean, the uncertainty is going down, but what's actually happening is sticking around, right?
Yes.
I mean, the effective tariff rate, we have a baseline of 10%. We still have effectively, what Secretary Besson talked about as a trade embargo with one of our largest trading partners. I mean, that's still there. And, recent news on sanctioning Iranian oil, right? I mean, that's basically a shot at China. A lot of this stuff is just beyond my pay grade, like the geopolitical stuff. I mean, when they just, you saw Besson talking about the Ukraine deal, right, that they just signed.
Yeah.
And he's like, no one that funded the Russian war effort is going to be able to take part in this reconstruction money.
Right.
That's aimed at China, Iran, and North Korea, right? So, look, I don't think it's about the uncertainty. The uncertainty may be peaking, but it's what's actually happening. And that is a significant tax shock to the U.S. economy.
Here's my take on the market. We've got a few things going on. Sentiment is washed out. Horrendous. So
I agree.
We have been climbing the wall of worry. Going into the end of 2024, it was like everyone's in. You need a wall of worry to climb. Absent then everyone's on the same side of the boat. We now have that to climb. Joe Weisenthal tweeted, big tech and big banks have totally erased their losses since April 2nd. Where there's basically been no recovery is in stuff like trucking or energy. So it's not just one market. It is an index of all sorts of different companies. And if you look at what is driving the market, at least the cap-weighted index, technology names, they are on absolute fire.
Yeah.
So Microsoft just reported, this is from Alex Morris, Microsoft cloud run rate revenue is up to $170 billion. The trailing 5-year CAGR is 26% per year. This shit is incredible. And you're seeing this in Meta and Google. And these are the names that are most representative of what's going on when people talk about the stock market.
They have the right. So in other words, what's happening with them is more important than some of the industrial stuff that these are smaller market cap companies.
Yeah.
They don't have the same push and pull.
So I said, if there was an index, and actually we say it, John, chart 9, please. If there was an index for like Main Street, it would be down 40%, like for the real economy.
Right.
If you look at the performance of large cap versus small cap, this is indicative, I think, of the real economy because Microsoft and Google will be able to absorb whatever comes, whatever uncertainty happens, they're going to be fine. Small cap stocks, obviously smaller businesses, are going to be in deep shit.
Mm-hmm.
The Chamber of Commerce, which represents small businesses all over the country, wrote a letter to the White House today, open letter, so everyone could see it. They're not suing the White House like some of the farmers are and some other groups, but they're basically saying like, okay, so large cap tech has all these loopholes. We're not going to have tariffs on technology products, consumer electronics, iPhones. Those are all exempt. Great. NVIDIA's chips, exempt. So it's like all of the things that matter to the stock market are exempt from the tariffs. The Chamber of Commerce is like, what are you going to say to millions and millions and millions of small businesses? So here's the question. Can you have a recession for small business, but publicly traded large cap stocks just levitate? Like none of that is going on? It seems like such a huge disconnect.
I mean, I think it might be possible for some period of time.
Periodically.
Yeah, but I think fundamentally, I mean, if you're in a recession, that's going to take the overall market down because people are going to be risk averse and they're going to sell and raise cash.
Okay.
That's sort of my view.
But the earnings aren't coming in.
Yeah, the earnings. That's what I was going to say.
So the problem is you have these incredible earnings. Now, granted, these are for Q1 before their tariffs. But what if the things that Microsoft and Netflix and Spotify and Apple sell, the services they sell, are the last thing people cancel? Because that's how these stocks are trading.
Well, I mean, to me, I think about what's the link between the stock market and the real economy, right? And there's multiple ways you can kind of go with that, right? Like, so there's the first is the idea that like the stock market's basically an active informant, right? I mean, that's sort of, again, this is a good conversation because the academic literature is like, this is a whole literature about like the stock market financial accelerator model of the economy. And so basically, when times are uncertain, the stock market might take on more of like a macro aggregator role. Like companies look at the stock market for, are things looking up or down, kind of.
Yeah.
And other times it's like a passive informant, right? Like, so the idea is that there's nothing about the share price of Apple that's telling Tim Cook something about that firm that he doesn't already know.
Right.
And so we're kind of going back and forth between the two. But ultimately, I think if stock prices are going down for a lot of these smaller companies, that's raising their equity cost of financing, and it's going to make it more challenging for them to borrow. And ultimately, that's going to mean that they're going to be cutting back. And
I guess this is what I'm asking you.
And that's going to hurt the economy, I think.
In prior eras, and to this day, when there were worries about the real economy, like the mainstream, not the stock market, the mainstream economy, people who invest in stocks for a living and have to be fully invested at all times, they buy something. They buy utilities. And the reason why they buy, and phone companies, the reason they do that is because they're defensive companies.
Yeah.
And they know as bad as the
Bonds and
economy might
drag.
get, as bad as the economy might get, people aren't cutting off their electricity. So that's why, okay, what if the new utilities are things like cloud computing and things like the services that Apple sells and Netflix? What if those are defensive? The way that consumers look at those services, I'll get rid of everything before I turn off my cell phone.
They're utilities with 60% margins.
Right. What I'm saying is, what if this is a defensive rally? being led by tech. We think tech is growth, but in reality, these are among the most consumer defensive companies and services in the world.
But tech is you're right.
Fair?
You're fair. Fair end. Microsoft, which has been in the shitter for the last, 9 months, has gone sideways to nowhere, is rallying today because it had explosive earnings growth.
Right.
But to your point, how do we disentangle the stock market from the economy? In many ways, it is the same thing. We're talking about the same thing. So, for example, Delta, all the airlines are cut in half, as they should be. Airline travel is slowing down. You see it in the data. You hear it in the earnings calls. Okay, so Delta is not saying we're not going to invest on Google or Meta because our stock price is down 50%. They're saying, wait a minute, our stock price is down 50% because our earnings are going to get hit, and also we're going to pull back on advertising because of this. So it's hard to untangle what's
Except
happening.
that they don't. In reality, what they do is they cancel all other forms of advertising and they double down on the duopoly of Meta and Google.
So
And
that's probably right, true.
And here's why. Because it's the most reliable. So when more are flush and people are spending more on advertising, they'll spread the budget around. They'll do podcasts, they'll do TV, more money at the ballpark, more money on the PGA events on TV. When things get tougher,
That's to your point. That's the last thing to get cut.
Yeah, he's
the
right.
last thing to get cut is the Facebook budget. You can't afford to. If you have a marketing budget, even if I tell you as the CFO, your marketing budget is down 25%, you're going to say, well, I know for sure that Instagram ads work.
So I guess on the trajectory that we're on, why doesn't that ultimately get taken out?
What do you mean get taken out? Because
Well-
I don't think anyone thinks we're having a depression. So a recession,
Even a mild recession wouldn't do the job.
Dude, there's multiple tranches here.
Right.
you know why even a mild recession wouldn't do the job? Because there's still too much inefficient advertising and marketing money being spent away from the duopoly. There are magazine ads being sold right now. So I still think even in a recession, advertising revenue on those platforms holds up better. Amazon's a really great example. They have the third largest advertising business in the world. Almost nobody thinks of them this way, but
Right.
it's true. If you're a third-party seller and you're worried about a recession, what's the one line item you can't cut? The ads you buy on Amazon to sell your product.
Right.
That's like literally the most effective advertising you do. What you can cut is the stupid influencer that you have putting makeup on their social media account. So I think that defensive quality of the Mag 7 is underappreciated reason why those stocks are actually being bought before and after their earnings reports. I think there's just a comfort level that nobody's going to stop spending there.
I mean, you have seen some defensive, movement in the equity market. I mean, right, like consumer staple
Yeah.
companies outperforming consumer discretionary. You mentioned like some of these logistic companies getting worse. So
Healthcare has been hanging in there.
Yeah.
That's defensive.
right. So, it's
Listen, I don't think we're saying that a recession is bullish for stocks. I think that what we're
I'm sort of saying that.
I think what we're just trying to make sense of the rally. Right? Because we know the economy is slowing and it's probably not going to accelerate. And yet the market has rebounded. So I think we're just trying to make sense
I
of
mean,
how.
I think it's also that. It's also, Treasury Secretary Besson's on the tapes more, telling everyone that deals are coming.
True.
And that goes back to your point about trade uncertainty going down, right? So if people have more clarity around that, then that's another reason to be, getting back into the game. So I don't think it's all just tech. I mean, that's been a big driver of what's happened more recently, like in the last couple of days.
Yeah.
They
But-
said there's a trade deal with a huge country, but we have to wait till tribal council to find out who it is. They won't, literally, that's how they're bringing.
Well, I mean, I think we have can say with a reasonable degree of confidence that it's going to be it's either India or Japan. I mean,
Okay.
that's probably who it'll be.
Let me ask you a question. Fast forward 6 months. There will be tariffs, right?
Yes.
Okay. So
Yeah, I don't think he's backing off. So I
Okay.
guess, I think that
consumer prices will be higher, right?
consumer prices, yes.
So that's all else equal, not a positive for the economy. I guess the big question mark is ultimately what happens to the labor market? Because as long as we have jobs, we will absorb higher prices. We will not stop spending.
Well, I don't necessarily agree with that. I mean, right now people have jobs, but total wages and salaries are slowing quite meaningfully. I mean, if you look at just the data through March, private sector wages and salaries. So that's everything, right? That's jobs, hours, and hourly earnings. That's up less than 3% over the last year. Whenever you have a situation where the Fed funds rate's running higher than that number, it's usually not good. I mean, good things typically don't happen. It's basically a sign that the household sector is becoming more budget constrained, and the Fed's basically saying, okay, we're not doing anything about that just yet.
Well, you are starting to see that in certain areas. So McDonald's this morning, for example,
sure,
they said that their breakfast is softening a lot, and Carl Quintanilla tweeted like, well, that's probably the first thing to go. That's probably the first leading indicator of job losses is ultimately people saying, or not people saying, people that are not employed are not getting the McDonald's breakfast.
Right.
So maybe we will start to see that.
We go to chart 4. This is from your blast today. What are we looking at here?
So the white line is basically rate cuts being priced for this year, and the orange line is just
stocks,
the equity futures. Yeah.
So that's a very pronounced divergence. Like, I like that we're reacting immediately to this idea of rate cuts when you see them zigzag to that extent.
I mean, if stagflation is lower stocks and higher rates, and recession is lower stocks and lower rates, the market's basically telling you that we're back to soft landing cuts, right? I mean, that's
the implication here is,
in my opinion, yes.
The implication here is you're going to get your rate cuts, and stocks are front running it by rallying.
Yeah.
Okay.
Do you think that they should be cutting in May?
I do, because I have a more negative view on the labor market. I think the big story that people have missed is that the economy was actually a lot weaker than people thought going into the year.
Say more about that.
Well, I mean, it's. I think the prevailing sort of narrative was that Trump is inheriting this awesome economy. It's like gangbusters growth, and we have all. I mean, it was a deeply imbalanced economy. I mean, the housing market was frozen, it still is. Labor markets were sluggish, right? I mean, quits rates were at lows, hiring rates, recruiting intensity were at lows, job openings were declining, so the labor markets were frozen. State and local governments were projected, no matter what was going to happen this year, to spend less money because they basically have exhausted their pandemic relief money, but they behaved as if that pandemic relief money was going to be permanent.
Right.
So there was going to be a decline in state and local government spending and investment, no matter what was going to happen this year. So I think it was inevitable that the economy was going to slow down. And, I think that's evidenced by the fact that total income growth is slowing through March. So it's really hard to say that that's a function of tariffs and Liberation Day when it's a March data point.
What do you think the Fed would have been doing absent the trade war?
Cutting.
Already?
Yeah, I think May would probably be baked. Yeah.
Do you think we would have had a cut already, a March cut?
I think they probably would have used the March meeting to
telegraph May.
To TF. Yeah.
Okay, and now we're not going to have a May cut.
No, I mean, I think. Look, I've been very open about this. I mean, I thought it was very unfortunate that in November, Powell basically came out and said, "Look, it was like the day after the election. We don't prejudge. We don't predetermine. We don't make any judgments about policy." And then, literally in December, he's like, "Well, actually, we do."
Yeah,
and they basically took out an insurance policy against
by not cutting. They took out an insurance policy.
Well, I mean, it's really about the distribution of the risks that they adopted in December. Like, Trump hadn't even come into office, and they basically all said that the risks to inflation were skewed to the upside because they were very concerned about all the things so they were prejudging what he was going to do.
Nobody thinks they're going to cut in May. At least
I do.
No. I'm just saying the market probabilities, it's like 95% for no cut.
If he doesn't cut in May, it's going to be an explosive moment in Washington, D.C. Bessent was on TV saying, the 2 year is telling you need to cut. Like, Bessent is not a Treasury Secretary that does not understand markets.
Yeah.
That ISM number today, there's 3 straight months of contraction in manufacturing. Like, I think he's going to cut. And I think the reason he's going to cut is to show that he's not a slave to the bond market and the expectations. Like, it's going to come off as though he cut because Trump made him. But I'm just telling you, I think he knows that he has to cut, and he's just going to do it.
Well, if the next jobs numbers, we're recording this on a Thursday, so
Yeah.
if
Tomorrow,
if the next jobs number comes out like a dud, then those probabilities may shift. I still don't think it'll be enough to save the May pricing, but
It's 95%.
yeah.
Like
Yeah, to me, it's I don't think they'll go. I think June is definitely
June's up to 55% for a
Yeah.
cut.
Here's the thing, though.
I think the Treasury Secretary is totally spot on. I mean, basically, that's the sign. I mean, that's a sign that policy is too tight.
The 2-year.
So do
Yeah.
I. And the Fed does follow the 2-year. And I think there's going to be a cut and it's going to surprise people. But then I think people are going to, like 2 hours later, realize the Fed doesn't cause inflation or fix it. So it doesn't matter. If the Fed cuts because financial conditions are too tight relative to the economy, people shouldn't interpret that as, oh, the Fed's going to make prices higher. The Fed has no power to make prices higher. The tariffs are making prices higher. No one's going to blame the Fed for this inflation. They should
Well, that's
cut.
true. That doesn't mean that they
No
don't.
one?
Well, okay. One person will.
The Fed controls the. I mean, don't go saying that in the Economist building, Josh. I mean, if you tell someone at the Fed, a monetary policymaker, that you don't control inflation, they might bite your head off.
They couldn't for 10 years. They were trying to stoke inflation and they couldn't. They 0% interest rates. They put the foot on the gas and held it down. And then they did quantitative easing, 3 rounds. They could not stoke inflation. I would say by the same logic, if they cut interest rates by 25 basis points, it doesn't change anything. Inflation will be determined by the tariffs, period, full stop. If the tariffs go away, then prices will ease. And if the tariffs stay on, prices are going higher. The Fed could fiddle.
Well, the prices for I mean, I think it's about the nominal anchor, right? Like, so if you put a tariff on, right, on something, the price for that good will go up. But there's no evidence that, like, the federal government is accommodating that, right? Like, it's not like government spending is going up. So the nominal anchor isn't really changing. So that means household budgets, if the price for TVs go up, you'll have to spend more on TV. You'll have less left over to spend elsewhere. And that's going to drive down the prices for
which destroys demand, which leads to disinflation, therefore power should cut.
Yeah, ultimately, yes,
Yeah.
I agree.
Okay.
I agree. But he was very clear about the sequencing here. Powell was, right? I mean, he basically said, look, we're coming off a period of very high inflation. I think that means we should worry about inflation expectations. And because tariffs represent a supply shock, and we've been going through multiple supply shocks due to COVID, we should be a little bit more cognizant of that. And also, the scale of what we're talking about here goes beyond anything Trump did in his first term. So I agree with you that I think ultimately the Fed will cut, and I think they are a little bit behind.
Can we go back to the first term? In 2018, we were in a hiking cycle during the trade war. And the idea was we better hike rates to get ahead of these higher prices that the tariffs were going to cause. What the tariffs ended up doing was causing demand destruction and uncertainty. And when he said in the fall, I'm nowhere near neutral on policy rates.
That was what killed the market, actually.
It's the same thing now. This idea that I'm not going to cut because I don't want to exacerbate higher prices or expectations, I guess in this case, it's the same thing. You ain't going to have to worry about that. If these tariffs stay on for 6 months, the economy is going to have tons of demand destruction because nobody could afford to pay these prices.
So do you think that they actually come off the tariffs? Like, you think he capitulates on the 10% baseline tariff?
Yes, without ever saying that he's doing so. It's a no. It's Swiss cheese at this point. It's cutouts, carve-outs, loopholes, exceptions for almost everyone.
I mean, we are collecting money on tariffs. I mean, if you look at like the daily data, excise taxes, customs duties, those are all going up now.
It would be unusual. And I
don't think he capitulates, because if he does and he actually rolls back the 10%, I mean, that's it. He's a lame duck.
He rolls back the auto tariffs. Is that not the same as capitulation, basically? Isn't that what this is all about? Can't sell our cars in Europe, can't sell our cars in Japan.
I don't know what it's about, honestly. I mean, it's we're trying to reshore domestic manufacturing, and now we're talking about how much rice and soy we're going to sell to Japanese. So,
right, but if you say no, all right, if you roll back the auto tariffs, then what is the trade war about?
It's just
soybeans.
Well, no. Well, the trade war is about something that he fundamentally wants to do, which is tariffs. Like, that's like a 10% universal
for the sake of tariffs.
Yes.
Yeah.
I mean, look, everyone's sort of saying, well, there's so much confusion because you're doing this As
Fentanyl.
It's escalate to de-escalate.
Pay for
It's a
tax
revenue.
cuts.
I mean, and they're trying to say it's both.
It's very simple. He's saying, we buy so much from you. Why don't you buy any of our stuff? Isn't it that simple?
Well, I think
in his mind?
Depending on the market.
Yeah, I think it goes beyond that. I also think that this is fundamentally like what he believes. And so he's basically saying, if you want entry into our market, you have to pay 10%.
I bet you if he just said that, he could say, I won the trade war. But that's not where we are. We're at 150% tariffs.
Yeah, but I think that ultimately, I guess my view on it is you have a 10% baseline, and these negotiations are basically going to be used as like a pretense to just, continue to delay the reciprocal tariffs that he announced on April 2nd. So I think we're still stuck with 10%.
Well, let me ask you this. Has there ever been a time in history where inflation expectations were going vertical and the Fed was cutting? It would be very unusual. Now, this is a very unusual period of time.
I mean, you had a period in 2008 where global demand was still very strong. The U.S. economy was getting worse at the time. The dollar was cratering.
Oil was rallying.
Oil was surging because of global demand, I guess, and inflation expectations were rising. And there was a period there that summer where the Fed was like, I don't know if we should be cutting. But that was, I think,
in Europe, they were hiking.
Yeah, in hindsight, that was a mistake.
So if Josh is right and they do a surprise cut in May, what happens to the market? What do you guys think?
I think the market is I think the market is probably, if it doesn't rally, then what we're going to say is the market anticipated the rate cut.
Yeah.
I would assume that if the Fed does a surprise rate cut in May, then the likelihood is that all those companies that you're saying are still underperforming, like the non-tech companies,
right. Catch up.
So we're gonna get April non-farm payrolls by the time people are listening to this.
Don't worry, I heard it's good.
If that's an incredibly strong report, then forget everything I just said.
Yeah,
because I don't think.
Well, you may find out sooner. I mean, it's like maybe at like 7:45 a.m. Like we get a Truth Social post. Looking forward to the jobs number.
I wouldn't be surprised. I wouldn't be surprised. Did you want to do the sentiment chart, or
no? We did that.
We did that already. All right. What do you want to go?
Let's talk about the economy. So we got GDP reading yesterday. Not great.
There's a weird asterisk in that, though. The GDP reading, right?
What's that?
It was like something with an import calculation.
So Liz Ann Saunders tweeted, net exports subtracted nearly 5 percentage points from the first quarter in GDP, most in history. John, chart 12, please. Neil, explain this to us. What are we looking at here? And if this is not meaningful, we could blow past it.
I mean, there was a threat of tariffs that pushed up imports, which cut GDP. So, that's all that is.
All right. So
exports net of imports is why you would get.
You had a front running of the tariff, so imports surged. Now, ultimately, imports have to go somewhere. So they went into investment. They went into inventories. So that's basically what happened.
What was your read of the quarter?
My read of the quarter was that consumer spending is growing below the rate of is basically slowing down. That to me is the most important thing. Income growth and consumption growth is moderating. And the big story, in my opinion, is that over the last year, consumption has been growing almost twice the pace of disposable income, right? You have about 3% consumer spending growth and like 1.5% consumption. So everything that's going on right now, in my view, would augur for a higher saving rate, or at best, maybe the savings rate's stable. But people see, home prices are slowing. The stock market is volatile. Like these are reasons for people to be a little bit more cautious, or they have a little bit higher precautionary savings.
There's an
rate.
explosion in unsold home inventory in Florida now.
Yes, exactly.
Which is probably a leading indicator for something. You have people that basically have been running a race to spend as much as they can, go on as many vacations as they can, and to your point, they're still sort of on the stimulus high, but they don't have the money. But they're still spending at the same pace,
and
you can't keep doing it unless the economy all of a sudden speeds up and people start making enough.
So so exactly, that's exactly right. And so if the savings rate is stable, then at best you're going to be looking at like 1.5% consumption. So if you assume everything else is more or less zero, maybe you get a little bit from AI like CapEx, but you're basically talking about like 1 to 1.5% growth at best. And if that's the case, that's not a situation that's below potential. So that's going to be a situation where the unemployment rate tends to go up. I think it'll end up being weaker than that for what it's worth. But it just tells you that the best case scenario is still pretty soft.
So let's talk about this. We have the Conference Board of Consumer Confidence, and every metric of consumer confidence is rolling over. John, chart 14. Just not great. Heather Long tweeted, this is stunning. 44% of Americans now believe they will be worse off financially in a year, mainly due to tariffs. We've never seen anything like this before, not even during the Great Recession or the stagflation era. It's hard to imagine that this doesn't impact how people spend. Maybe we shouldn't buy the TV. Maybe we shouldn't take the fourth vacation. Maybe we shouldn't do whatever. How does that ultimately not happen?
How does it not happen?
How do you get out of it? Once it rolls to this degree, put that last chart back up prior to this one.
Like, is it possible that we look back on this as being noise?
How do you escape this? It's crazy. That's crazy.
I mean, I think it's going to be some combination of capitulation on the trade war and rate cuts that would ultimately get you out of that. But even then, I mean, once the confidence genie's out of the bottle, it's really hard to put it back in. It takes time. And probably reacceleration in the job market. That could be something.
Well, that's going in the wrong direction now. So
Correct.
we got Challenger, Gray, we got continuing claims are at a multi-year high.
Yes.
What was your read on today's precursor to tomorrow's jobs report?
The labor markets are all slowing down. I mean, everything we see suggests that the labor markets are
all
slowing
pointing
down.
in the same direction.
Yeah, I mean, you mentioned the Challenger data. It's not a data point I normally pay much attention to, but what's interesting about that is why there are job cuts. It's the firm saying that it's because of economic conditions. I mean, a month ago it was because of Doge, and now it's because of economic conditions, corporate restructuring. I mean, if everyone's restructuring at the same time, that becomes a macro issue. Continuing claims. I mean, continuing claims are rising.
It's 2 million people.
Correct. Which means
that's a high number.
Well, it means that unemployment's going up.
Yeah.
And
continuing claims. Continuing claims is initial. There's initial claims. How many weeks elapse before somebody that is an initial claim becomes a continuing claim?
Well, if you're filing and for like basically you have 6 months on continuing before those are exhausted. I mean, it depends on the state.
No, but how soon after you go from an initial claim to a continuing claim?
Oh, it's immediate. I mean,
it's immediate.
It's a week later.
So you file for your initial unemployment claim, and you're counted in the data of continuing claims immediately.
Yeah, basically a week later. Yeah.
Okay. Is one more important to you than the other? For your process to understand what's going on,
I think
or you
continuing
look at both?
claims are. I think Well, I mean, if you're waiting for initial claims to go up, then you're waiting too long because that's like basically.
I agree with you.
It's like a credit spread. I mean, it's episodic when it goes up. So that's like in a measure of layoffs, and if layoffs are rising in a material way, that means the Fed's waited too long, and you have basically nonlinear risk.
But continuing claims is people sitting on unemployment insurance for months and not getting rehired. And
continuing claims tell you about how difficult it is for someone to find a job. Like so one of the and this is something I talked about with Paul Krugman is it's the bathtub model of unemployment, right? Like so you can kind of forecast what the level of water will be in a bathtub based on how much water is going in and how much water is being drained out. And what we can say about unemployment is that, the good news is that layoffs aren't going up. So that means that the water's not flowing into the tub any more quickly. But what we do know for sure is that it's taking a lot longer to drain that water out. So it's taking a lot longer for unemployed people to find work. And over time, that ultimately means what? The level of water, or in this case, the level of unemployment will go up over time. And that's kind of where we are right now.
It's a sequence of things like picture a corporation. So they were hoarding labor for a while. Like, we're not going to let anyone go because we don't know if we could hire them back. Nobody's worried about that anymore. And then all of a sudden it's like, no more lunches, no more coffee, no more trips. We cut the travel. They don't lay people off until they absolutely have decided we're in layoff mode. Okay, so that part takes a really long time, to your point. But like, I think we're at the point now where not just Fortune 500, but every business in America has enough uncertainty where maybe they're not firing all their staff, but they're not hiring. And that's why it's harder to get hired right now than it's been in years.
Yeah, and the margins, I mean, tariffs represent a margin squeeze ultimately. Tariffs increase costs. Who ends up, it's an open question about how much they raise consumer prices, but they increase cost. And I think, frankly, one reason why consumers are still holding up, right? I mean, you see like these, Visa saying consumption's fine, like everyone's saying consumption's
They're still
fine.
working.
Not only that, but they haven't actually felt the effects of tariffs because a lot of these companies think that the president's going to back off.
Yeah.
And so they think that it's temporary in nature. So they're willing, with margins being very elevated, they're willing to eat the cost. I have my skeptics. As I said, I think that some of the tariffs are going to stick. So ultimately, this is a margin squeeze that they're going to have to deal with. And ultimately, I think that's going to mean weaker investment, hiring, and some firing as well.
Does that show up in a month or in 3? Like, if you had to guess, like, when does that become obvious to everyone that it's here?
I think it could be as soon as May.
Yeah.
Where would we see that?
I mean, I would look at manufacturing, employment, construction. I mean, things that are very affected by the tariffs.
This idea that if we do go into a recession, whether like a technical one or not, the economy slows down. People say, well, the consumer has never had a better balance sheet. Corporations have never had a better balance sheet. Therefore, the recession should be moderate. We can weather through. Recessions suck. What's your take on that?
We're going into a recession in really good shape.
Yeah, I mean, I think I think that's a reason for it to be like mild. I mean, we don't have like deep imbalances in our economy, right? I mean, it's not like you had a massive CapEx boom like you did in the late 90s. I mean, that might just be getting started, quite frankly. Housing is not stretched. I mean, if you look at residential investment relative to GDP, it doesn't appear to be out of whack. So I think all of these are good reasons to expect the recession to be relatively mild. But I also think that the recovery will probably be quite slow because to me it's a confidence issue, right? I mean, I think in some respects, like, what are we talking about here? Like a lot of these deals that we're talking about, are they really deals or are they IOUs, right? I mean, are they just deals to just have extended negotiations? And doing trade deals is not easy. Like it's like a win if you can get like one of those over the finish line. And what's interesting to me is the administration talks about like the phase 1 China deal and how Biden didn't enforce it. Well, you're about to go embark on hundreds of phase 1 deals. So if you're a company, like, why do you think any of that stuff sticks?
Yeah.
And so I just think, so there's this confidence shock that's happened, which is completely, I mean, one of the things I said early on with the president is that he didn't have a lot of levers to pull because the truth, in my opinion, is that Biden went to the fiscal well one too many times and is like very much limiting their ability to do things. So really,
Inflation Reduction Act, CHIPS Act, what else?
Infrastructure.
Yeah.
So that basically meant like the one thing that he could do is just sort of
tax the world.
Well, no, like just keep the animal spirits going, right? Like just make people think like, look, we're going to get this tax reform done. We're going to do deregulation. These things are all coming down the pike. And that's where the optimism initially came. But what did he start with? He started with the most growth unfriendly part of his agenda first. Yeah. And I think that he's in it for the long haul. Like, I think fundamentally this is what he believes. And that's why I don't really think that we should expect some kind of capitulation. And remember, this isn't the end. I mean, Section 232 tariffs are coming. That just requires a period of like studying it. But you're going to get Section 232 on pharma, semiconductors.
What does that mean?
These are national security tariffs.
So, because they really want to make sure that we're manufacturing this stuff here.
Yeah.
I mean, agree. That's the part that's not going to change.
And you can debate the merits of that. But look, I mean, this is what he got elected to do. And so he's doing it. So I think it's a period of transition for corporate America. And that uncertainty is going to be problematic to navigate. And I kind of liken it a little bit to like the 01 to 03 period, right? Like that was a mild recession. But back then, it was just like confidence shock after shock, right? It was 9/11. It was corporate scandals. We had like accounting reform, right? And then we had like the run up to the Iraq War. And it took like so much to get things going, right? You needed gobs of tax cuts and like a 1% Fed funds rate. And unfortunately, right now, we don't have the fiscal space really to deliver that.
One thing about the tariffs is that the money being collected is supposed to offset this extension of the Tax Cuts and Jobs Act, which they're going to try to get done before the end of this year, have to get done before the end of this year. So if you get rid of the tariffs, well, that was one of the sources that was going to pay to keep the tax cut. So I don't even know that you want to see the end of all the tariffs, even if it ends up being a higher cost and you're a corporation.
Yeah, I mean, also, but I would just say that the way they're going about this, like carve-outs and, specific items are tariffed at different rates and so forth, that makes enforcement very challenging, right? So it's a fairly inefficient way of raising money, which is why, to me, it's, look, believing in tariffs is sort of like the price of entry to ride down the escalator with DJT, right? Yeah. And so, I always said, like, look, if you're going to do this, the best thing to do is just start at a baseline of 10% and then go on a bilateral basis against specific countries. I saw like a senator from Nebraska talking about like, oh, he's totally right to do this. This is after like the Liberation Day announcement. He's totally right to do this. Like the Brazilians are killing us on ethanol. It's like, okay, so why don't you do it like Price is Right? Like Brazil, you're up next. Yeah. And let's talk about ethanol. And then just go to, you could have done this in a way that probably wouldn't have created so much market anxiety.
I meant to ask you, speaking about the market, what's Jeff's take on the stock market these days?
So he's said that he's been saying bear market rally.
So have I.
Oh, interesting.
He's been saying bear market rally. So it's actually, I think, very good for our client base because, we don't have like a mandate at RenMac to like everyone has to have the same
you could disagree.
View. Yeah. But I think it's helpful really for our sales force when, I'm basically saying, look, like I think things are slowing. Like I wouldn't really be chasing this rally. And he seems to be saying similar things.
What's this trends in consumption chart? Is that worth?
We could skip it. I wanted to talk about this. I really like this chart from Torsten Slack, which shows U.S. corporate revenue exposure versus U.S. exports to China. So, okay, we only export $144 billion to China. Not a lot. Obviously, a huge imbalance there. However, look at the S&P 500 revenue from China. It's $1.1 trillion. Neil.
It goes against what you just said, though, earlier, right?
Which part?
Well, because, it's... In this case, the stock market should actually be performing worse because of the tariffs. But that's not what's happening. The stock market's generally been going up.
I guess my point, or Torsten's point, I think, in this chart that is so stark, it's like, yes, if you are just looking at the difference between what we buy from China, what they buy from us directly, sure, there's an imbalance. But oh my God, look at our companies and how much revenue they're doing in China. Starbucks, Apple, all of these companies that have huge amounts of revenue.
Disney, this is right. This is the thing that the anti-tariff people have been saying from day one. It's like, yeah, of course, we buy a lot of plastic shit from China and sell it in Walmart, and it's junk, and we don't want to make that here.
To say nothing of the dollars and the bonds that they're buying.
But we sell financial services all over the world. We sell software. We sell intellectual property. We sell things that have 50% profit margins all over the world. That's what's at risk. The stock market doesn't believe it. Like the participants in the stock market don't believe that that's really at risk, I guess, would be the only guess that I could make at why they don't think it's at risk.
That goes back to the thing we talked about earlier about why is there the disconnect between the stock market and the fixed income market. It's that basically you're saying that they'll pull back on the trade war.
If we roll and make new lows later in the year, this will have appeared to be the dumbest rally we maybe have ever seen.
What, the last 8 days?
Yes.
Yeah. Well,
I think one risk, frankly, if it's, we're talking about the tech sector. I as I've said, like, I think if I'm thinking about it in a macro kind of, I think it's basically the investors betting on deals, right? Like whenever Scott's out there talking about deals, like things are coming, we're going to rack up these, the market goes up. And that's part of what it is. I wonder whether when we get that first deal announced as a framework, does the market sell off on that news?
Well, given that we've rallied so hard, probably. Yeah. But I am of the posture generally, I don't think the market's dumb. So if I disagree with the market, I generally defer to the market.
Right.
Isn't there room to say the market's not dumb And every time we've been in this cataclysmic situation where the S&P is down 15, 20%, which is where we just were in early April, it's been a head fake. And so the market is smart, and they bought that dip aggressively. But there will be one time where they buy that dip aggressively, and it's the wrong move.
I think given where we came from, you're right. Given that the S&P was up 20% in 23, up 20% in 24, and that the S&P is down 4% this year, doesn't make sense to me.
There's another dynamic I want to talk about. Wall Street strategists have completely thrown in the towel on this year. The retail is going the opposite direction. So let me read this to you. Deutsche Bank, coming into this year, had the second highest S&P target for 2025.
Okay.
This is, I think, Monday. Deutsche Bank's Binky Chadha, one of Wall Street's biggest bulls entering 2025, is going back on his optimistic views on U.S. equities. The bank's chief U.S. equity and global strategist cut his year-end S&P 500 target to 6,150 from 7,000. That's a pretty big cut, guys. The new forecast signals an advance of just 4.6% from where the benchmark began the year. The old target was for 19% upside. Again,
hang on,
Chadha had
what? The S&P is at 5,600. That is not, I mean, yeah, 7,000 is ludicrous at this point. You better be cutting.
Okay, but I'm just making the point. Chadha had the second highest target, following only Oppenheimer's John Stoltzfus, who also cut his year-end target to 5,950 from 7,100. So the two guys above 7,000 are now with a 5 handle on their target, and these are really big cuts. I'm not saying they shouldn't have. Here's the chart. So this shows you where they started the year, and this shows you where they are now. This is Goldman, Bank of America, Evercore ISI, RBC, JP Morgan, Yardeni, Oppenheimer, Barclays, BMO, Deutsche. Now they're all in the 5s and low 6s.
All right, so we're at 5,600. To me, this is not bearish enough.
But let me make the counterpoint to that. So while Wall Street's throwing in the towel on this year, here's what retail investors are doing. Emma Wu, a global quantitative and derivative strategist at JP Morgan, said in a note to clients late Wednesday, retail stock buying boomed last month, even as Wall Street pros worried about recession. Retail traders, this is a crazy divergence. Retail traders net bought $40 billion in April, surpassing March and setting a new record for the largest monthly inflow. Historically, retail investors bought aggressively, daily imbalances exceeding $4 billion on both April 3rd, as the day after Liberation Day, when the market experienced its first 5% drawdown since 2020, and April 9th, which saw the largest one-day gain since 2008. They bought down, they bought up. They bought every day, a record-setting amount of stock. So I don't know that we could say the market's smart or stupid, because the market participants are going in opposite directions. One will be right. Retail will be vindicated, or the strategists will be vindicated. But it's very clear they disagree. Your thoughts?
Or we just sort of chop around and go nowhere.
No, but one's going to be, fine. In that scenario, then nobody looks like they were quote unquote right.
We're going to have another movie about it, like Dumb Money.
Yeah.
Who's right, who's wrong. I mean, I think, look.
Sorry, Robinhood, 77% jump in year-over-year transaction-based revenue. They just reported this week.
But people are conditioned over the last number of years to buy the dip.
Yeah.
Yes.
So that's
really? Wall Street's nervous? Here's another 50 grand.
It reminds me a lot of like the 2016, like when the Fed started hiking. It's like a big thing was like, well, no one's actually lived through a hiking cycle.
Oh my God, they wouldn't stop. The
media
would not stop with that.
And it's like sort of similar in this sense, is that, a lot of equity investors haven't really seen a meaningful drawdown in the market.
Or actual stagflation.
Yeah.
They haven't seen it. They're not afraid of it.
And as I said, that goes back to that's why I say, like, none of these answers are in my mind, like, good. I mean, it's like, is it because it's like innocent until proven guilty? Like the economy is innocent until proven guilty. Like maybe that's the case for these retail investors. It's like, yeah, you guys have been telling me like things are going to be falling apart for years. You said it in 2022 and 2023.
Right. So I agree with that. So that's why the market is quote unquote smart, because they're saying this is the 10th recession in the last 10 years. None of the other 9 have happened.
Right.
I'm buying. So that makes them smart. But one of these times, it'll be the wrong time.
Exactly.
What's a more entertaining outcome for you? 3 months from now, the strategists are chasing the stock market again, and they all have to raise their targets after they cut them 19% in the hole. Or the market's down 3 months from now, and the retail capitulation starts. What's a more interesting outcome of this? I'm not saying which will happen. What do you think would be more interesting? Not that you root for anybody to lose money or be wrong.
Yeah, I mean, I think it's the potential for things to get worse. That to me is sort of more interesting because we haven't really seen that.
I don't think retail capitulates.
Wall Street will look really smart if there's another drop of the magnitude of April later this year.
Yeah.
All these guys who cut their targets, they won't look smart, but they'll look better than they would look.
I mean,
in the
right
other
now,
direction.
I think I agree with Michael. Like most of these estimates are just marking to market your forecast. They're not actually like bullish or bearish. It's like one of these things where like price, you don't have a choice but to. Like
the market falls
20%.
You can't leave a target at 7,000.
It's ludicrous.
It's like you're at that point, your compliance department's calling you up and be like, "Can you please,
But I think this idea that investors will stop. Maybe the dip buying slows down. In fact, yes, if we roll over to new lows, they will be certainly less excited about putting new money to work. But they're not going to puke their Google or Amazon or whatever they just bought a month ago. They're going to hold on. They're going to say it'll come back.
So I think what it would take for retail investors to capitulate is not the depth of a sell-off. I think it's the length of a bear market. Everyone has their limit. I think it's.
Was there any selling in equities when we had in
2022?
Right.
Very little. No, open-ended mutual funds.
NASDAQ stocks.
ETFs took in money because they always do.
Structurally, they always do because of retirement investing. It's almost automated. I asked you for this chart earlier today. We looked at this period after the dot-com boom turned into a bust. That you referenced that period into 2003. There were 10 distinct 5% rallies,
right,
while
the S&P fell 52% from peak to trough. The trough was like at the end of 2002.
Brutal.
Isn't that a great chart?
Brutal. That will wear you out.
You see the light blue highlight portions? Those are 5% or more rallies, and each one of them failed and led to lower levels. I'm not saying that the rally we've just experienced is that. I'm saying it very well could be. And people are not even thinking that that's possible. They can't imagine it.
But so that stops the buying. It won't make people puke, I think.
We'll see.
Listen, obviously certain people will, but I'm saying like in aggregate, if you're looking for the retail, Vandertrack has a lot of great services on this. Like they track retail buying and selling. I think you will see buying dry up if we continue to roll, but I don't think they're going to start to hemorrhage their stocks.
Yeah, I mean, I think to me, it's like you always want to be invested. It's really about whether you want to put new money into the market or not. And
I agree with that.
And I think, I mean, my view is that you'd be less likely to put new money into the market.
Well, guess what? I bought the panic 3 weeks ago. I will be less enthusiastic about putting more money into the next one. So will everybody else.
Right.
The first panic is the easiest one to buy.
Yeah, of course.
The fourth panic, it's like, I'm not doing that again.
That's not fun anymore.
What is the question that you're getting most from institutions or hedge funds right now about the situation?
I mean, I'm getting a lot of questions on policy, not really the economic data. I feel like
on Fed policy.
Yeah, I mean, and also fiscal. Frankly, like what do you think about what the administration's doing? I had this thing about how whenever Scott Bessent talks, it's good, and whenever Howard Batnick.
That was a great chart. We showed that last week.
So I've been getting questions on that. I mean, I feel like, on the economic outlook, I was cautious going into the year, and I feel like the consensus has more or less caught up with that.
Yeah.
And I think right now it's kind of this, again, like people are asking, like, what's the data point that's going to make it, like, give you that aha moment?
You're not a data point guy.
Yeah, I mean, I think, it's really tough because it's not like things are collapsing, like, right? Like, so the market collapsed, I guess you could say. Like, you had a very big, and people are expecting like sort of instant gratification in the
now that the stock market crashed, show me the bad economic data. It's not there.
I don't think it works that way. I think this is, it could have happened. I mean, but I think to the extent that they've sort of moderated their tone on the trade issue to some extent, that's like sort of reduced the risk of like a nonlinear type of event in the economy. So I think it's kind of, I mean, tariffs don't really mean sudden stop. It's not like COVID. It's not like a credit event. It's not sudden stop. It's painful, and it could be a process more so than anything else.
Do you have a viewpoint on like what final GDP for this year is it like sub 2% growth?
Oh, I think that's bad. I mean, I think it'll be close to zero. Yeah.
You think it'll be close to zero?
Yeah.
Is that kind of what everyone thinks now?
I mean, I think people still think that there'll be positive growth. I mean, I don't think people think the labor markets are going to fall out of bed.
Wall Street still thinks like 9 to 12% growth for earnings.
Yeah, I mean, so to me, that's going to be very challenging in a nominal growth environment. That's
right.
You know, if you have tariffs, like whatever goes into P is going to be coming out of Q, right? Price times quantity. So, and nominal growth is very sluggish. So how are you going to get 10% earnings with nominal growth running 3%?
Yeah. When the next Fed meeting happens, what do you think the stock market would prefer? Would they prefer no cut because things aren't really getting that bad, but a dovish tone from the Fed kind of telegraphing like, all right, but we're definitely doing cuts this year? Or do you think they just want the cut? Like, what would be better for like the mentality of the stock market? Because there is a school of thought, and there is some data when the cuts start, it's actually not great for stocks. It's the anticipation of the cut is better than the cut itself, because the cut might mean something's not going well.
Well, I think if the Fed is cutting in May, that probably means that things are going to get worse between now and then, which is why I don't think that they'll cut in May. I do think, so I mean, I think the downside risk for the market is if you have some kind of like hawkish hold where he basically says like, look, we're not doing anything right now, and we're thinking inflation is surging, and that's why we can't do anything.
Yeah.
I think what the markets would prefer is that, you know, something like we're monitoring the economy closely.
Okay, so this jobs number is a big deal. I know we joke around about every jobs number is the most important ever. This one's kind of important.
Yeah, I mean, we're right, because we've seen a fairly significant, like one of the ways you catch a recession in real time is you have to look for what Greenspan called like data discontinuities, right? Like if you have like a bunch of 200,000 on NFP, non-farm payrolls, and then all of a sudden you get like a 25.
Yeah.
Like that to me is like, oh, that's interesting. Maybe that means something bad's happening. And
hey, you know what didn't work very well? Speaking of discontinuities, the SOM rule was triggered. I don't know what they were on SOM rule watch, but that was something with like the shorter term versus the longer term unemployment rate.
Yeah, I mean, that could have also been like a function of like labor force dynamics and so forth. I mean, you know, but as I say, I mean, you have data discontinuities already in all of the survey data, right?
Yes.
Like, you know, consumer confidence wasn't great, but it wasn't like awful either. I mean, it was kind of bobbing around, and then it
fell off a cliff.
And then it fell. Right. You look at capital spending intentions across the regional manufacturing surveys, sort of same thing, right? It just collapsed.
Yeah.
So that's so you have discontinuities already in some of the data. Obviously, the NFP number is the one of the highest quality, so that's the sort of thing that we.
All right. Last thing. How's this for a scenario? The real economy falls apart, like the physical economy, but so long as 3 companies reaffirm their AI spending capex for this year, the stock market's just whatever, it's fine. Like that sort of seems like what's going on right now. They're hanging on to every word from Microsoft, Amazon, Meta. Will you keep spending on AI? They're like, yes. The
but
NASDAQ rallies 400 points.
I mean, we know how tech booms go, right? I mean, there's an adoption period, and you are seeing that in the data, right? Like more companies are adopting AI, and that's going up. But ultimately, you hit a saturation point, which then undercuts the rationale to continue investing. And
we're not there yet.
That overhang could be very painful. So this, again, goes back to the idea that if the economy is only firing on one cylinder right now, and then there's an overhang later, it just creates a very soggy recovery on the back end of this, even after the Fed's cut.
So speaking of AI CapEx, Meta, to Josh's point, like they upped it, their guidance. As you guys were talking, Amazon reported. So I'm on the Quarter app, and it gave me a suggestion to ask the chatbot. And the suggestion was, how does AWS growth compare to peers? Because that is a huge driver of Amazon stock price. And in 3 seconds, not 3 seconds, let's call it 30 seconds, I got Amazon up 17%, AWS up 17% year over year.
That was the number.
Azure up 33% year over year. Google Cloud up 28% year over year. So Amazon is down 4% in the after hours, primarily because of their AWS report. And I this is sort of a tangent side point, but like the AI stuff is just wild. I don't know about you, but for me personally, I have been using it way more, even in like the last 3 weeks.
What do you use it for? AI
Stuff like this.
Okay.
I think we're all using it, and
I use it for cartoons.
Say more. You create cartoons?
Yeah,
Okay.
I mean, that's what we use AI for.
So I think people are using it and don't even realize they're using it at this point. That's where we are. It's so built into so many of the products at Microsoft and Alphabet. It's a huge part of our lives already, and we don't even know it. The deliberate use of AI, probably not as prevalent as I thought it would have been.
Like people going to ChatGPT specifically.
My biggest fear
I
is
think
if
that's off the charts, but like Apple's AI rollout at this point, I think it's safe to say, was just an absolute debacle. Like they don't have it in China. The app here, they launched in 2 phases. So when you got the new iPhone 16, like the AI was
Not
indistinguishable from regular Siri. So like Apple didn't really get going on AI to the extent that I thought they would have. And as a result, like we're using AI when we search for something and Google gives us a result up top before the blue links. It's an AI result. Nobody's like blown away by it. It's just like, oh, that's how Google search looks now. So I don't know.
Facebook, so Zuckerberg yesterday on the call was saying that the AI agents are getting so good that advertising will be a bigger percentage of GDP going forward. And if he's right, and there's reason to suspect that he might be right, it makes sense why these stocks are behaving the way that they are. They can continue to take share, expand their earnings in a shitty economy.
So to me, the interesting thing about this is that this just shows kind of like the evolution of how an economy goes, right? Like the bigger, right? Like you start off on the farm, then you go into the factory, and now we're kind of going to the upper heights of like the knowledge economy and just, putting everything on a computer. I thought
everything is computer.
Azure, Microsoft's cloud doing 26% compounded for the last 5 years at these numbers. There's no comp.
But it just shows you that like we're at this knowledge-based economy, and yet like the political economy, we're trying to get back into the factory.
Yeah, well, right. They want to reverse it.
It's very difficult to right? Like these are like big, sweeping, secular changes that are really hard to shift with policy.
I just want to point out, though, we're whistling past the graveyard with like big misses, McDonald's, UPS.
No, I agree.
10 years ago, we would not have ignored the commentary from these CEOs and had a plus 2% day in the S&P. It would never have happened. And that's how big these AI issues are. They're so much bigger and more important to the stock market than the companies that we used to think of as bellwethers. I don't even
remember Caterpillar?
Yeah, they would seize on a report from Alcoa.
Yeah.
Because it was the first earnings report. Caterpillar, UPS, FedEx. What those companies said was the tone for the stock market for a week.
By the way, this is Alcoa. And if you look at a chart of any materials, they look like ass. Materials are breaking down.
To me, it's actually quite, it makes me a little nervous because it's a very imbalanced economy, and it seems like a very imbalanced
stock market.
Yeah.
So I was joking around, like as long as those 3 companies affirm their AI capex, none of this other shit matters. It's like half joking because it's half real. That's what's going on right now.
Yeah.
We're not going to solve this today. Do you have fun on the show?
I always have fun with you guys. Absolutely.
So I think the best way I could kind of encapsulate your thinking right now is we're going to have a slowdown. The question is for how long and the severity.
Well, I would just say that all slowdowns, not all slowdowns end in recession. All recessions start with a slowdown. And I tend to think that the markets might be underappreciating the risk of recession at the moment.
I think that's fair to say. Michael and I both agree with that. All right. We always end the show asking people what they're most looking forward to. Neil, you have Knicks stuff in here? Did you know Michael's a Knicks fan?
I couldn't tell.
You know what? I am looking forward to this series being over. I'm not having fun. And it's not just because we're not performing.
I
well,
mean,
it
even
is
if we
not
win,
performing.
we're going to lose in 5.
In
and then-
5 games. Yeah, it's going to be debacle. So I'm thinking about going to Boston either on Monday or Wednesday just because I want to be in the building, but I kind of don't want to be humiliated. Like,
and they kind of might not be there.
We're going to lose. Well, there's that. But we're going to lose by 29 points. Like, do I really want to go to Boston for that? I don't know.
Right.
No,
Yeah.
you do not. Can I help you? Wait for the MSG game. They'll probably lose that one too. Do not go to Boston.
Yeah.
Do not go to Boston.
What
and
do you
if
think
they,
the odds
and
of
if they blow the Celtics off the court, you could be mad at
That's
me.
not going to happen.
Thibodeau?
This is it for him.
I want him gone. I'm not mad at him. I love him. I thank him for his service. He has taken this team as far as he possibly could. Thank you so much. We need a new coach.
We need one of these sexy new coaches like a JJ Redick. We need like somebody in their 30s.
Like a poster?
Yeah.
We need somebody we need an offensive-minded coach. We need Ty Lue. I know he's not available, but like we need somebody that can run this offense because we are not maximizing our capability at all. Last year, the sum was greater than the parts, and this year it's the opposite. We have too much talent to be playing this way. It's really
I
upsetting.
agree. Yeah.
One of the problems with only playing 7 guys the entire season and putting 35 minutes on all of them, when you get into the playoffs and you don't have a bench that can score, well, what do you want from these guys? They barely had to play, other than injuries. So you need Brunson and Cat to combine for 70 points to win these games.
Yeah.
It's really, really hard for that to happen, and you have no plan B. I went to the game on Sunday in Detroit. Shout to my friend Jason Rasnick.
He's talking a lot of shit to me in the DMs.
Yeah, I bet. So I want to say one thing about Detroit. They love basketball.
Yeah.
Like that arena goes to 12. And we happen to have pulled out the victory by like 1
point.
1 point. There might have been a foul. They didn't call the foul. We won the game. We squeaked by. But that place was just lit the entire game. They really love their team in a way that I don't think, like, I've been to a bunch of NBA arenas, not necessarily in the playoffs, but like I just feel like Detroit's a special basketball
Was
place.
it Malice in the Palace? Did you?
Yeah, that was a different place. That was Auburn.
Right. But
This was Little Caesars. The coolest thing about Detroit, all 3 teams play next door to each other. So Ford Field for the Lions is next door to Comerica, and across the street is Little Caesars for the Red Wings and the Pistons.
That is awesome.
That's cool.
And then they have like a million sports bars, and they had like outdoor parties going. Like it's a amazing sports town. And apparently there were a lot of people who would go to a Tigers game and a Pistons game in the same day.
That's amazing.
Well,
Like
Jeff
around
is a
this-
big. No, he's from Michigan.
He's a Red
really?
Wings guy, right?
Well, yeah, and also
I
a big
didn't know that.
Lions fan too.
Lions fan. Okay. Anyway, shout to Detroit. Thanks, Jason. Met Jared Goff. He was front row at the game,
Okay.
sitting next to Jason. Who else was there? Chris Webber was there.
Ben Wallace and Jalen Rose.
Yeah, it was.
They don't talk to each other.
But like all the Detroit celebrities were out. I found that kind of
Right.
cool.
Yeah.
It was a very cool scene. What are you looking forward to?
I told you. This
What are you looking for? You have
being
Knicks
over.
too.
Well, I mean, I'm looking forward to them closing out the series tonight.
I think we're going to win
It's not
tonight.
gonna
but I'm
happen.
well, Jude, relax.
All right, you think? In Detroit,
I do, but I'm not like super
they
confident.
barely escaped alive on Sunday.
I think we're going to win, but I'm not betting on it.
All right, I'm looking forward to dinner. We're going to a corner store tonight. You ready for this?
I love it.
All right.
Whose joint is this?
This is Mark Birnbaum, who is the owner of Catch and Catch LA.
Oh, we've
I
been there.
took you to Catch LA.
That was hilarious.
This place is the shit. They have the French dip, like the roast beef.
Yes, I've had it. It's good.
Oh.
The steak is good. Also,
Steak is great.
they have this, Girl Scout cookies. They have like a Samoa sundae,
Yeah.
which is fantastic.
It's gonna be great. I'm looking forward to dinner. All right, that's it from us. Great job. Thank you so much to the team, John and Duncan in the room right now. You guys crushed it this week. We did a lot of great stuff. Neil, where can people follow you? Where do they get your stuff? They go to renmac.com.
You can go to renmacaccess.com.
renmacaccess.com.
Sign up for a trial of our work. You can always find me on LinkedIn.
Who are your customers? Is it mostly institutions or individuals as well?
Well, we're trying to do both, but we have a multitude of institutional type accounts: long-short equity, pension funds, multi-asset strategists, and RIAs as well. So
You guys go to renmacaccess.com if you want to learn more from Neil and the entire team at RenMac, whom we are huge fans of. We love all your stuff. Neil, thank you so much for doing the show today.
Thank you.
And all right, guys, that's it from us. We'll talk to you next week.